Alright, so for my topic, I had foreign exchange rates and conducting international business. So the factors influencing foreign exchange rates, the definition of this is the rate at which one country's currency may be converted into another. One of the most important means through which a country's level of economic health is determined. Provides a window to the country's economic stability also. This is something people must watch for when they're sending money overseas. So, for example, the currency exchange rates. What might be worth a lot here might be worth a little overseas. So it might not even be worth it to send it. Some factors are inflation, interest rates, terms of trade, political stability, and economic performance. Inflation rates. A country with a lower inflation rate than another's will see an appreciation in the value of its currency. And a country with a consistently lower inflation rate has a rising currency value, while a country with a higher inflation rate typically sees depreciation in its currency and is usually accompanied by higher interest rates. And for interest rates, they are correlated with inflation rates, as you can see from above. And the increase in interest rates can cause a country's currency to appreciate. Higher interest rates provide higher rates to lenders, which attracts more foreign capital. This then causes a rise in exchange rates. Terms of trade. It is the ratio of export prices to import prices, and it improves if its export prices rise at a greater rate than its import prices, which makes sense because you want the ratio to stay above 1 or you want it to stay a whole number. This results in higher revenue, which causes higher demand for the country's currency and an increase in its currency's value. The increase in value results in an appreciation of the exchange rate. Political stability and performance. A country with less risk for political turmoil is more attractive to foreign investors. As a result, it draws investments away from other countries with more political and economic stability. The increase in foreign capital in turn leads to an appreciation in the value of its domestic currency. A country prone to political confusions may see a depreciation in exchange rates. Spot rates and cross rates. So spot rates are prices quoted for immediate settlement on a commodity, a security, or a currency, and it is the current market value of an asset at the moment of the quote. It reflects the supply and demand for an asset in the market. And a cross rate is the rate between two currencies as they relate to a third currency, which is usually the US dollar. So, for example, the Bank of England sells or purchases euros for yen, which is the currency in Japan. Foreign exchange risks. The risk that an asset or investment denominates in a foreign currency will lose value as a result of unfavorable exchange rate fluctuations between the investment's foreign currency and the investment holder's domestic currency. There are three types of risk: transaction, translation, and economic risk. So transaction, a company faces this when buying products from a company located in another country. The price of the product will be denominated in the selling company's currency. This could potentially have to make a larger payment if the seller's price appreciates. Translation is when a parent company that a subsidiary in another country could face losses when the subsidiary's financial statements must be translated back to the parent company's currency. Economic risk refers to when a company's market value is continuously impacted by unavoidable exposure to currency fluctuations. Foreign investment decisions. Opportunities for economic growth for both countries involved. Operating branches in more than one country is beneficial because of the opportunities for cheaper production, labor, or lower or fewer taxes. So this is why a lot of car manufacturers will build cars overseas, because it's cheaper than to do it in the US. Otherwise, our car prices would be sky high. They can be direct or indirect. So direct are physical investments and purchases made by a company in a foreign country by opening plants and buying buildings. So anything physical. Indirect involves companies, financial institutions, and private investors buying stakes or positions in foreign companies that trade on a foreign stock exchange. This form is less favorable because the domestic company can easily sell off their investment very quickly. Funding of foreign transactions. So Exim Bank, Export-Import Banks, or Exim Banks are government or semi-government agencies that ensure the safety and growth of a country's foreign trade. In the US and other countries, they provide trade insurance and provide you tips on how to invest in other countries. They also offer financing to keep your export business running. Loans from the parent company or sister company. So this relates to earlier when we talked about translation risk. Loans from the parent company have to be converted into the correct currency in order for the subsidiary or sister company to use them. This means that the parent company might have to fork over more cash in their own currency than they would in the sister company if the roles were reversed. So more on funding of foreign transactions. Eurodollar loans. Eurodollar refers to the US dollar denominated deposits at foreign banks or at the overseas branches of American banks. Eurodollars are held outside of the US and therefore are not subject to regulation by the Federal Reserve Board, including reserve requirements. So the overseas banks are not required to hold a certain number of Eurodollars in them. Eurodollar deposits can pay higher interest, and the offshore location makes them subject to political and economic risk in the country of their domicile. However, most branches where the deposits are housed are in very stable locations. The Eurobond market is made up of investors, banks, borrowers, and trading agents that buy, sell, and transfer Eurobonds. Eurobonds are issued by European governments and companies but often denominate in non-European currencies such as US dollars. The funding of foreign transactions, this is more on it. International equity markets, markets in which shares are issued and traded either through exchanges or over-the-counter markets, and they're also known as international stock markets. They ensure the participation of a wide variety of participants, but they also offer potential for global economies to prosper. Stocks or shares can be bought or sold internationally in this market, hence the name International Equity Market. This is a type of indirect investment in a foreign country because there is no physical ailment to the share. So it's intangible. The share is intangible. You cannot actually touch it. They can be less desirable because of the risks involved in the companies that buy them can sell the shares off very quickly. So there's more turnaround, I guess that's what you would call it. And here are all my references, so you can go through and read more on each of the topics if you want. I hope this was beneficial to you, so thank you for watching.